When Russia's invasion of Ukraine began in February 2022 and Western nations responded with an unprecedented package of economic sanctions, the strategic logic seemed compelling and the expected outcome relatively straightforward. Cut Russia off from global financial systems, restrict its access to technology and capital, freeze sovereign assets, and the resulting economic collapse would either force Moscow to the negotiating table or render it incapable of sustaining prolonged military operations. Nearly 4 years later, however, that calculation has proven far more complicated than anticipated. Not only has the war continued with no clear end in sight, but Russia actually recorded impressive GDP growth figures during 2023 and 2024, prompting widespread debate about whether sanctions had genuinely failed and whether Russia had demonstrated a remarkable capacity for economic resilience under pressure. The reality, as a deeper structural analysis reveals, is considerably more troubling. Not for the West, but for Russia itself, because that growth was neither organically generated nor sustainably structured, and the Russian economy now appears to be entering what analysts and economists have begun describing as an economic death zone. Borrowing the mountaineering metaphor used to describe the altitude above 8,000 meters on peaks like Everest, where survival is possible but by no means guaranteed, where every decision carries outsized consequences, and where the margin for error is vanishingly thin. Just as a climber in the death zone cannot afford complacency, denial, or impulsive decision-making without risking catastrophic collapse, Russia's economic policymakers find themselves navigating an environment where the headline numbers still look passable on paper, but the underlying structural dynamics are deteriorating in ways that could, if left unaddressed, culminate in a severe economic crisis, a condition some have termed survival by self-cannibalism, meaning the economy is essentially consuming its own future productive capacity in order to sustain present-day military operations. To understand how Russia arrived at this point, it is necessary to trace the origins of the 2023 to 24 growth surge with some precision, because that growth was real in a nominal sense, even if it was illusory in a structural one. When sanctions were imposed, one of the most significant and immediate financial responses was a wave of capital repatriation. Russian oligarchs, corporations, and high-net-worth individuals who had parked substantial assets in Western financial institutions suddenly found those assets frozen or inaccessible, and simultaneously faced strong incentives, both legal and patriotic, to bring their offshore capital back into the domestic banking system. This repatriation injected a large volume of liquidity into Russian banks virtually overnight, and when combined with the household savings that had accumulated during the COVID-19 pandemic and had not yet been fully deployed into consumption or investment, it created a pronounced and temporary liquidity boom. Russia's broad money supply, measured by the M2 aggregate, expanded sharply as a share of GDP, rising from approximately 46% to around 56%, and banks, flush with deposits, responded by extending credit aggressively. The credit growth, however, did not flow primarily into the sectors of the economy where it might have generated lasting productive capacity. Small and medium enterprises saw relatively modest increases in lending. CORPORATE loan books were essentially flat or even declining in some segments, and agricultural lending showed no significant uplift. The bulk of the credit expansion went into household mortgages, which did create a short-term demand stimulus. Households borrowed to purchase homes, spent more on goods and services, and generated economic activity in the near term, but which did not directly expand the economy's ability to produce more goods and services in the future. This distinction between demand-side stimulus and supply-side investment is critical, because it explains why the liquidity boom was structurally transient rather than self-sustaining. Simultaneously, the Russian federal government made a decisive choice about where to direct its own fiscal firepower, and that choice was almost entirely dominated by the imperatives of the war. Defense expenditure rose to approximately 7 to 8% of GDP and came to constitute merely 40% of the total federal budget, a wartime mobilization of resources that has few peacetime parallels among major economies. Defense manufacturing expanded at a remarkable pace. Total manufacturing growth figures of around 18% were recorded in certain periods, but virtually all of that growth was concentrated within the military-industrial complex, producing weapons, ammunition, armored vehicles, and related equipment rather than consumer goods, agricultural machinery, medical devices, or the technological infrastructure that drives long-run productivity. The defense sector did create real economic activity in a technical sense. It employed workers, paid wages, generated income that was then spent in local economies, and contributed positively to measured GDP. Unemployment fell to historically low levels and wage growth was recorded across parts of the economy, particularly in regions with significant defense manufacturing presence. But this employment and wage growth was heavily concentrated in a single sector serving a single client, the state, rather than being distributed across a diversified economy capable of meeting the varied consumption and investment needs of the population. The fundamental macroeconomic problem this created was a growing mismatch between demand and supply. Households had more income and credit, and therefore more purchasing power. But the economy's productive capacity was being channeled overwhelmingly into goods that ordinary consumers cannot purchase or use. Tanks and missiles do not appear on supermarket shelves or in furniture stores. Essential civilian goods, from food products and household appliances to construction materials and clothing, faced supply constraints, and the predictable consequence was the emergence of significant inflationary pressure. Russia's inflation rate climbed to approximately 9.5%, more than double its own central bank's target range of around 4%, eroding real purchasing power and creating growing hardship for ordinary Russians even as nominal wages appeared to be rising. Faced with this inflationary dynamic, the Central Bank of Russia did what central banks around the world do under similar circumstances. It raised interest rates sharply and repeatedly in an attempt to cool demand and bring price growth back under control. The policy rate was pushed up dramatically, reaching approximately 21% at its peak, an extraordinarily high level by any standard, before being brought down modestly to around 15.5% in more recent months, as some inflationary pressures have begun to ease. But these interest rate levels carry their own severe consequences for economic activity. When borrowing becomes this expensive, businesses that might otherwise have invested in new equipment, expanded their production lines, or hired additional workers, instead shelve those plans entirely. Households that were financing consumption through credit find that new borrowing is prohibitively costly and begin to deleverage, pulling back spending. The very demand that the government's fiscal transfers and the earlier credit boom had stimulated began to collapse under the weight of monetary tightening, and the GDP growth trajectory shifted sharply downward. The International Monetary Fund has projected Russia's economic growth at approximately 1 to 1.5% for 2025 and around 1% for 2026, a dramatic deceleration from the 4+% rates recorded in 2023 to 24, and growth that remains largely dependent on continued defense spending rather than any genuine improvement in the underlying productive capacity of the civilian economy. This is precisely the character of the death zone. You are still moving upward in a technical sense, still recording positive growth numbers, but the conditions sustaining that movement are unsustainable. The oxygen is thinning, and the risks of a sudden deterioration are rising with each passing period. On the external revenue side, the picture is similarly sobering. Russia historically derived a substantial and strategically vital share of its government revenues from the export of hydrocarbons, crude oil, natural gas, coal, and liquefied natural gas, and the bulk of those exports went to European customers, who were willing to pay market prices and offered a geographically convenient and commercially reliable trading relationship. Sanctions, energy embargoes, and the political realignment triggered by the war forced Russia to pivot its energy export strategy almost entirely toward Asian markets, with China absorbing approximately 33% of Russian crude exports and India becoming a major purchaser of discounted Russian oil. This pivot preserved export volumes to a significant degree in the short term and provided Russia with continued revenue inflows during 2023 and into 2024. However, the Asian pivot came at a meaningful cost. Russia was compelled to offer significant price discounts to attract buyers who had alternative suppliers and faced their own political sensitivities about being seen to directly underwrite the Russian war effort. Shadow fleets of uninsured and anonymously owned tankers were deployed to circumvent sanctions, adding logistical costs and operational risks to the export process. And as Western sanctions have been progressively tightened, with major Russian energy companies now facing more stringent restrictions, and secondary sanctions threatening to penalize third-country firms that do business with sanctioned Russian entities, the export revenue picture has begun to deteriorate. Oil and gas receipts, which constituted the dominant share of federal revenue during the windfall years of high global energy prices, are now stagnating as a proportion of total government income, even as overall nominal revenues continue to grow modestly through other means. India, which had been one of Russia's most important new customers for discounted crude, is itself facing pressure from the United States within the context of ongoing trade negotiations, and there is a realistic prospect that Indian purchases of Russian oil could be reduced meaningfully as New Delhi seeks to manage its broader, strategic relationship with Washington. These converging pressures on the external revenue base narrow Russia's fiscal options at precisely the moment when domestic spending pressures are most acute. To compensate for declining hydrocarbon revenues and finance the continuing costs of the war, the Russian government has turned to domestic taxation as an additional revenue lever. The value-added tax rate has been raised to 22%, corporate tax rates have been increased, and levies on specific manufacturing sectors including electronics production have been raised. These measures will indeed generate additional revenue in the near term, but they carry a deeply problematic economic logic. They function as a drag on the very private sector activity that would need to expand if Russia is to develop a more balanced and resilient economic base. Higher corporate taxes reduce the after-tax returns on investment, discouraging businesses from expanding capacity. Higher VAT is the cost of goods for consumers, further eroding real purchasing power at a time when inflation is already biting. The taxation approach essentially represents another dimension of the self-cannibalization dynamic. The state is extracting resources from the civilian economy to fund military operations, but in doing so it is weakening the productive foundations on which future recovery would need to be built. The analogy to a climber in the death zone consuming their own muscle mass to generate energy is apt. The immediate need is met, but the long-term capacity for survival and descent is being compromised with each passing hour. Beyond the purely macroeconomic dimensions, there is a human capital dimension to this crisis that deserves serious attention, and that carries long-term consequences extending well beyond the duration of the current conflict. The mass mobilization of labor into the defense sector, combined with the emigration of educated professionals who left Russia in large numbers following the invasion and exodus that affected IT workers, scientists, engineers, and entrepreneurs disproportionately, has created a significant labor market distortion. The workers who remain in the civilian economy are fewer in number, more expensive to hire due to wage competition from the defense sector, and in some cases less skilled than those who departed. This combination of labor scarcity and skill degradation tends to suppress productivity even as wages rise, meaning that Russia gets the inflationary consequences of wage growth without the corresponding efficiency gains that would justify those wages from a production standpoint. Investment in education, research, infrastructure, and the other long gestation assets that underpin future economic competitiveness has been systematically deprioritized in favor of immediate military needs, and the opportunity cost of that deprioritization will compound over time. The generation of Russians currently entering the workforce will inherit an economy with a narrower productive base, a more distorted sectoral structure, weaker institutions for innovation, and a heavier debt burden than the generation that preceded them, not because Russia lacks talent or natural resources, but because the choices made during this period have systematically directed those endowments toward purposes that do not generate lasting civilian prosperity. Russia itself appears to be waiting for the other side to blink first, calculating that Ukraine's dependence on Western financial and military support makes it the more economically fragile party in the long run, and that any reduction in that support, whether driven by political shifts in Washington, donor fatigue in European capitals, or simple budgetary constraints, will force Kyiv to terms on conditions favorable to Moscow. That calculation may or may not prove correct, but it comes at a cost that is not merely abstract. Every month that the war continues deepens the structural distortions described above, pushes the Russian economy further into its death zone, and reduces the range of options available for eventual recovery. If peace and genuine structural reform were to materialize, there is reason to believe Russia could navigate its way out of this zone. It retains substantial natural resources, a reasonably educated population, and the institutional memory of a diversified industrial economy from its Soviet past. But if the current trajectory persists, if defense spending continues to crowd out civilian investment, if taxation continues to suppress private economic activity, if inflationary pressures are managed only through demand destruction rather than supply expansion, and if the hydrocarbon revenues that historically provided fiscal breathing room continue to erode under sanctions pressure, Then what appears today as a slowdown carries a genuine and growing risk of tipping into a more severe economic shock, a recessionary episode, or, in a worst-case scenario, a debt and currency crisis that would constitute the very economic collapse that sanctions alone were never quite able to deliver.